Good afternoon, this is Sean Golding with Golding & Golding, here to discuss the basics of the inbound transaction rules and international tax. In general, when you're looking at the whole gargantuan world of international tax, the baseline initial analysis is it an inbound transaction, is it an outbound transaction? Is someone internationally investing from overseas into the United States, or is someone from the United States investing abroad? The purpose of this presentation from the title is going to be inbound transactions. So and it's going to be individuals, okay? It's different when you've got businesses and permanent establishments and all that kind of stuff. We're just going to focus more on individuals, right? Someone is overseas and they have some money, they want to invest in the United States. How does that inbound transaction work? So with inbound transactions, you're investing in the U.S. It's a non-U.S. citizen, non-legal permanent resident, or foreign national who doesn't meet the substantial presence test. That last category would have too many double negatives. The idea is if you're a U.S. citizen, legal permanent resident, foreign national who meets the substantial presence test, doesn't qualify for closer connection or one of the other exceptions or exclusions, you're taxed on your worldwide income. This is different when you're a non-resident and you're investing in the U.S., you're only going to be taxed on your U.S. sourced income, if at all. Because what's important is the sourcing rules, okay? Where is that money sourced from? And it'll vary, oftentimes, and we'll go through, we'll touch on it a bit, but, dividends are generally sourced in the U.S., capital gains not going to be sourced in the U.S., exceptions, exclusions, and limitations on that. But let's go through some of the basics. So let's take David. David is a non-resident alien, and he wants to, and I always dislike that term, it's too harsh, but it is what it is. Non-resident alien, investing into the United States. One common thing they might invest in is investment funds, okay? And this is important, right? For example, if someone's investing in let's say they want to purchase bonds, right? So maybe they purchase a bond fund. Well, when a bond fund distributes money, it's typically going to be dividends. Dividends are going to be taxed in the United States. It's going to be U.S. sourced. If instead, let's say the person is investing in bonds directly, and those bonds are generating interest, just an individual bond, it's got a 3% ROI, then you know what? That's going to be sourced non-U.S. Typically, interest is not going to be sourced in the U.S., okay? So that's why when you're making inbound transactions into funds or investments, it's important to really take a look and see what kind of income it's generating. The two most common types that we see here is real estate flipping and rentals, okay? Someone is a non-resident alien, they got a ton of money, they want to invest in the U.S., so they buy a couple properties, right? Maybe they rent those properties and then they want to sell them. Even though capital gains typically is not going to be taxed in the U.S. to a non-resident alien, again, exceptions and exclusions, and if the person's here for more than 183 days, it's taxable, yada, yada. But just baseline, okay, baseline. When you invest in the United States, the sale of U.S. property is going to be taxable under FIRPTA, Foreign Investment in Real Property Tax Act. And the U.S. government's going to withhold 15% normally of the sale price, not the gain. So you can imagine how brutal that'll be on a high dollar property. So it's important to do some planning if you're going to invest inbound for real estate. When it comes to rentals, unless an election is made from the income for the rental to be ECI instead of FDAP, and I have other presentations to go through that, but then the renter is supposed to withhold 30% and toss that to the IRS to make sure that the IRS is getting paid on. There's elections you can make so that doesn't have to happen, and then you can apply certain expenses like you would otherwise apply and just get taxed your progressive tax rate. Another investment in the U.S., of course, is foreign businesses that are investing in the U.S., but then one of the major concerns are going to be permanent establishment and things of that nature. When investing in the United States, one of the important aspects to keep in mind is the tax, right? It's important to understand how it's going to be taxed. So the baseline perspective is this. If you're investing in the United States for FDAP, fixed determinable annual periodic, then the U.S. is going to automatically withhold 30% of the money you're making unless you make a treaty election, if it's possible. For non-U.S. persons, they also have to be aware of the fact that even though capital gains is typically not taxable, that doesn't apply to all capital gains, and If the person is in the United States for more than 183 days, typically they're going to be taxed as a U.S. person. That's different than the substantial presence test. Also, there are the expatriate rules. Okay, if a person's an expatriate or a covered expatriate, they leave the United States and they maintain their U.S. investments, well, that's going to impact the ability and the tax. Okay, if a person is out of compliance, there's various options available to them. Those options will vary based on whether or not they have to file a tax return or not. A lot of these options are only available to U.S. persons who have to file U.S. tax returns. There's voluntary disclosure, streamlined procedures, reasonable cause, and delinquency. It may not require any of those programs when it's a non-resident alien. You should reach out and speak to a specialist to get the lay of the land. We have lots of information available on our main website, goldinglawyers.com. You can always reach out and schedule a reduced fee initial consultation if you think it's appropriate. Again, my name is Sean Golding with Golding & Golding. Thank you for your time. Enjoy the rest of your day.